Dear investor, Edelweiss Private Wealth Management is pleased to present you the latest issue of Investment Strategy Report for December 2017. Let's take a look at key highlights of November. Indian macros were slightly weak, with CPI jumping 30 basis points higher to 3.6%. IIP growth slowing to 3.8% in September and exports degrowing by 1.1% in October after a stellar performance in September. Moody's rating agency upgraded India's sovereign credit rating by one notch for the first time in 14 years, citing improved growth prospects driven by economic and institutional reforms. The current rating is Baa2 and the outlook is changed to stable from positive. Crude oil saw a major uptick to approximately $63 per barrel, which can impact inflation and fiscal deficit of the country. Indian equities market saw multiple levers for positive sentiment, like India's upgrade by Moody's and leapfrog in ease of doing business global rank for India to 100 from 130. Net profit of Nifty companies grew by 8% and top line grew by 12%. But the surprise came from expansion in EBITDA margins, which expanded by 40 basis points, indicating improving operating performance. Financialization of domestic savings is underway, with mutual funds AUM topping at Indian rupees 21.41 lakh crore as of October end, and monthly SIP inflow of 5,621 crore for October. This trend is expected to continue in a positive real interest rate scenario. Short term has seen a fear of fiscal slippage from increased government spending and rise in crude price, but stable macros will help retain FIIs going forward. We continue to remain bullish on Nifty as there are long-term growth levers like GST, government capex and domestic consumption. Road construction, cement, housing finance and microfinance continue to be our top sectors. EPS estimates for Nifty index for financial year 18, financial year 19 and financial year 20 are Indian rupees 492, 621 and 737 respectively. As per blended estimates, index is currently trading at PE of approximately 18.0 times 1 year forward. We recommend investors to deploy 33% of fresh equity allocation, while the remaining can get invested over a 3 to 4 month period in a staggered manner. Bond yields trended higher during the month of November, with 10-year benchmark GSEC hardening by around 13 basis points during the month after moving up 20 basis points in October. Global factors that contributed to higher yields were rise in crude oil prices, normalization of monetary policies, rising interest rates, and growth projections in developed economies. While domestically, it had been higher than expected PSU bank recapitalization and increase in inflation band from 4.2 to 4.6% by RBI Monetary Policy Committee for H2 financial year 18. The unexpected rating upgrade of India by Moody's was followed up by a surprise withdrawal of the next scheduled open market operations by the RBI, triggering a bigger rally in the market. In medium to long term, interest rates are expected to come down structurally. Going forward, repricing of fixed income portfolios at lower yield poses one of the biggest risks for investors. Investors should revisit their fixed income allocation and should rebalance their portfolios. Investors looking to earn reasonable returns with low risk should invest in long-dated accrual buy and hold strategies. Whereas investors looking to benefit from volatility should invest in active accrual strategies with moderate duration, preferably with low interim cash flows and instruments which can potentially benefit from rating upgrade and spread compression. We recommend investors to allocate 100% of their fresh fixed income allocation to accrual long-dated buy and hold strategies and active accrual strategies with moderate duration.